clearly there was some impact, John, from the Teamsters strike, or I guess the strike averted, we should say, but the costs associated with averting that strike.
Yeah, absolutely. In the second quarter, which is backward looking, it was more of a top line impact from the uncertainty surrounding the Teamsters negotiation. So management estimates they lost about 1 million packages per day as some of their shippers had to, take other outcomes to go to some of their competitors, about a third to FedEx, a third to the Postal Service, and about a third to regional carriers. The cost impact is going to be more forward looking. As this new Teamsters contract is finalized, the vote is going on now with the rank and file through August 22nd. So the margin guidance lower from the management about over 100 basis points for fiscal year 23 will incorporate a lot of the costs associated now with this new deal.
And we shouldn't just let them off just solely on the labor costs. There were some other issues challenging this company prior to the labor dispute, just with regards to consumer spending trends and, quite frankly, even some of the aggressiveness that UPS had in raising prices.
Well, I mean, I think the macro point, your former point, is the most relevant here. And clearly, there was a big shift to goods spending coming out of the initial lockdown. Then the pendulum has shifted very aggressively back to services. So all the transport companies I cover, from FedEx and UPS to railroads to trucking, have been hit by the shift away from goods and the destocking of both retailer and industrial inventories. You were speaking about China on the segment before this. The international market from UPS was very weak as well. Revenue down 13%, volumes down 6.5%, pricing down 5.7%. A lot of that is China exports. A lot of that is Europe weakness as well. So there's a big global, macro headwind that's still, involved here in the entire transportation space. It's just that the Teamsters agreement kind of exacerbated some of those problems for UPS and 2Q, and will continue to do so in the back half of this year.
And so focusing on the fact that you do have this shift in consumer, a shift to services rather than that big ramp up into goods that we saw during the pandemic, how does UPS compare to its peers? If this is an industry-wide issue, who is particularly well positioned to handle that?
Well, I'm not sure anyone's particularly well positioned to handle the shrinking pie, so to speak. I mean, UPS and FedEx have had the same type of volume headwinds. The difference is that UPS has been negotiating this contract, which has been a big overhang. The cost inflation from the contract in year one is quite high. We're estimating mid-high single digits, whereas FedEx is now transitioning to more of a restructuring of their ground and express businesses, and their costs are moving the other way around. But whether it's trucking companies who've cut guidance by 50% year to date, intermodal volumes have been down kind of in the mid-teens all year long. Rail volumes have been disappointing. What we really need is for this destocking process to end, for the consumer to become, a bit more aggressive on the goods side, and restocking to begin again from the retailers. And I think we'll get a good sense of that when the Walmarts and the Targets and Home Depots of the world report in the next 2 weeks.
Yeah, so maybe some visibility there. So interesting to hear all your comments and weigh that against the fact that you are in line on this stock. Now that we have some more visibility over the impact of the labor deal, in addition to maybe some color that we'll hear from Walmart and Target, what else would you need to see to bump that up to a buy, for example?
Well, let me address the first part first, which is we don't have full visibility yet. With the rank and file still voting through August 22nd, UPS management didn't reveal the entire terms of the deal. So the estimate reductions that we made today incorporated the guidance cut for fiscal 23 and our expectation for a lower base for 24. So, for example, we cut our 23 EPS estimate to 965 from 1070. It's pretty meaningful. And for next year, from $11 to 1025. But when the contract is all signed, sealed, and delivered on the week of August 21st, they will come out with another call detailing line by line the exact cost impact and timing and how they plan to offset some of that cost inflation through productivity and as well as through pricing. So we'll see exactly what the next 12 months holds, I think, in the next couple of weeks.